Hello everyone, welcome to Tesla Daily News. Today is August 6th, Thursday, and the following is the latest Tesla news. According to recent market data, Tesla's stock closed at $321.55, down from the previous close of about $327.35. The day's trading saw a high near $327.14 and a low around $320.28, on volume of roughly 27.7 million shares. In simple technical terms, short-term pullback within broader consolidation range. For investors, this suggests some profit-taking after recent volatility, but no dramatic breakdown in price structure. Traders will be watching whether the $320 region holds as near-term support and whether a move back above the mid-320s can restore upside momentum. According to the Motley Fool News article titled Better Robotics Stock, Tesla vs. Nvidia, analysts are increasingly comparing Tesla not just with other automakers, but with leading artificial intelligence hardware providers such as Nvidia. The piece argues that, within robotics specifically, Nvidia currently looks like the stronger stock. Nvidia is positioning itself as the core infrastructure provider for so-called physical AI, from humanoid robots to autonomous machines in factories and logistics. The company has launched Isaac GR00T, an open-source AI foundation model intended to serve as a general brain for humanoid robots. Nvidia has also introduced its Halos full-stack safety system for robotics, and its Jetson 4 robotics supercomputer is already being used by major players such as Boston Dynamics and Amazon Robotics to power real-time vision and speech processing. The article cites Morgan Stanley estimates that humanoid robotics could represent a $5 trillion market by 2050, with as many as 1 billion humanoid robots deployed worldwide. Nvidia CEO Jensen Huang recently said physical AI revenue is already at a $10 billion annual run rate and could become a $100 billion business for Nvidia within a decade. Importantly, Nvidia is funding this expansion with very strong free cash flow, almost $48.5 billion, without diluting shareholders or sacrificing profitability. In contrast, the Motley Fool notes that Tesla's approach to robotics revolves around building and scaling its Optimus humanoid robot. Tesla has reportedly decommissioned some Model S and Model X manufacturing lines to ramp up Optimus output, and it is planning a dedicated Giga Texas facility focused on robot production, with long-term ambitions of millions of units a year. Elon Musk has said humanoid robots could become the biggest product of any kind, ever. However, Tesla acknowledges that current Optimus units are not yet performing commercially useful work and are being used mainly for internal learning and data collection. Where investors are becoming cautious is the capital intensity and timing. Tesla missed a guidance target for 2025 Optimus production, delivering only hundreds of robots instead of several thousand. At the same time, capital expenditures jumped sharply, with second quarter capex reaching almost $5.8 billion, contributing to negative free cash flow of roughly negative $1.1 billion. The piece concludes that Tesla is in the middle of an identity shift, trying to evolve from a pure EV manufacturer into a broader robotics and AI company, but the near-term financial drag is considerable. From a robotics-only perspective, the author believes Nvidia currently offers a clearer, more diversified way to benefit from the rise of humanoid robots, especially since Nvidia can sell chips to any successful robot maker, including Tesla. For Tesla investors, this comparison has several implications. First, Tesla's robotics vision is extremely ambitious, but it is still at an early, heavy investment phase. Second, much of the margin in cash generation that supports Optimus and autonomy work still has to come from the core vehicle and software business. Third, while Nvidia looks more insulated and diversified in robotics today, Tesla's upside could be much larger if Optimus and vehicle-scale autonomy work as advertised. The risk-reward profiles are very different. One is a picks and shovels AI supplier, the other is a vertically integrated robotics and mobility platform that is currently cash-hungry. According to another Motley Fool article titled Cathie Wood's Ark Invest has built an $870 million Tesla position. Here's the thesis keeping her in. Major Tesla shareholder Ark Invest continues to lean into that higher risk, higher reward thesis. The article notes that Ark's founder Cathie Wood has used Tesla's recent share price weakness, including an 18% drop after the latest earnings call, as a chance to buy more. Ark reportedly added about $14.3 million of Tesla shares on the recent pullback, bringing its combined Tesla position across its exchange-traded funds to around $870.6 million. According to this report, Wood maintains an extremely bullish long-term target of $2,600 per share for Tesla by 2029, implying potential upside of more than 7 times from current levels. While much media attention has focused on Tesla's Optimus robot, Ark's thesis emphasizes robotaxis and full self-driving software as the main drivers of that upside. Wood believes that if Tesla can successfully deploy unsupervised full self-driving at scale, the company could dominate autonomous ride-hailing in many major cities and capture a huge share of future mobility profits. The article mentions that Tesla vehicle deliveries in the second quarter rose about 25% year-over-year to roughly 480,000 units, which still supports a large and growing installed base. Tesla is running early versions of its V15 autonomy stack to train robotaxi behavior, while customers today are receiving V14 supervised full self-driving in markets such as the United States and South Korea. According to Tesla, supervised FSD has already logged nearly 12 million miles, providing a valuable data set to refine the neural networks. In parallel, Tesla is beginning production of the Cybercab, its purpose-built robotaxi vehicle, described as the workhorse of the company's future autonomous fleet. Tesla has regulatory approval for unsupervised robotaxi rides in Austin, Texas, and in Florida cities including Miami, Orlando, and Tampa. Ark expects that if Tesla can extend similar regulatory approvals to a significant share of major U.S. cities, the earnings power from autonomy could dwarf that of Tesla's current vehicle sales. For investors, Ark's stance highlights a key divide in the market. Many current valuation models still treat Tesla primarily as a cyclical automaker with some optionality from software. Ark instead models Tesla as an AI-driven mobility platform where the majority of long-term value comes from software subscriptions and robotaxi network margins. This explains why Ark continues buying on weakness even as near-term profitability is pressured by capex for Optimus, AI training infrastructure, and new vehicle programs. If the robotaxi thesis succeeds, current drawdowns could look minor in hindsight. If regulatory or technical hurdles persist longer than anticipated, the stock could remain volatile and the $600 target may prove overly optimistic. According to 7 News and Car Expert coverage of Australia's July new vehicle sales, Tesla's operational performance in key markets is showing areas of strength despite competitive pressure. In July, Australia's new vehicle market hit a record for that month, with over 108,000 deliveries. Tesla's sales rebounded strongly from a weaker July in the prior year, with total deliveries of 4,778 vehicles, making Tesla the 7th best-selling brand overall in the country for the month. The report explains that Tesla's growth in Australia was driven by the introduction of the Model YL, a stretched version of the popular SUV, alongside a huge year-on-year rebound in the regular Model Y. Tesla now reports Model YL deliveries separately. Even with that split, both variants rank among the most popular vehicles in the market. The Model YL became the 5th best-selling vehicle overall in July, while the standard Model Y ranked 6th. Combined, Tesla delivered 4,644 SUVs between the two versions, surpassing strong competitors like the Ford Ranger and BYD's Ceylon 7 in total SUV deliveries, though still trailing the Toyota RAV4 and Hilux. The article notes that electrified vehicles, including battery electric, hybrid, and plug-in hybrids, approached half of all Australian new vehicle sales in July, with electrification reaching about 48.4% of the market. Within that context, Tesla's performance indicates that it remains one of the dominant electric SUV brands in Australia, even as a wave of Chinese competitors, including BYD, Chery, GWM, MG, and Geely, expand their presence. For investors and enthusiasts, this Australian snapshot is meaningful for several reasons. It shows that Tesla continues to gain traction in right-hand drive and export markets, not just in North America and China. It also demonstrates the importance of model diversification. By introducing the longer Model YL and targeting the large SUV segment, Tesla is broadening its addressable market. Finally, the data underscores the intensifying competition from Chinese brands, which are growing quickly in Australia and pushing overall EV adoption higher, but still leaving room for Tesla to maintain premium positioning and healthy volumes. According to the German outlet Focus, labor relations around Tesla's European operations remain a point of tension and risk. The report covers the ongoing conflict in Sweden between Tesla and the industrial union IF-Metall. After a long-running dispute over collective bargaining agreements, the union has announced a renewed strike call from mid-August. However, the article highlights growing disillusionment among some Tesla mechanics who had previously supported the strikes. The piece centers on a mechanic named Frederick in Stockholm, who reportedly has been on strike from the beginning of the conflict. He learned of the new strike announcement through media reports rather than direct communication from the union, and responded that he would ignore the new call. He criticizes what he sees as poor communication, a lack of transparency, and a feeling that local workers had little real influence over decisions that directly affected their income and job security. Another mechanic, Tobias Stromberg, who is described as one of the early key figures in the dispute, has now left the union after more than 2 years of involvement. Frederick says he felt relief when he was temporarily allowed to return to work at Tesla, and claims that the company welcomed him back and immediately sent him for training. He states that solidarity among workers has eroded and that he doubts many colleagues remain committed to continuing the strike for a collective agreement. For Tesla investors, this development suggests that while labor disputes in Sweden have been a reputational and logistical challenge, the union's internal fractures may be reducing the risk of a prolonged disruption. However, the underlying issue of Tesla's general stance toward European labor standards and collective bargaining remains unresolved. The situation could still influence regulatory attitudes and public perception in other European markets, particularly as Tesla expands manufacturing and service coverage in the region. According to the South China Morning Post's roundup of recent electric vehicle and new energy news, Tesla's strategic position in China remains central and complex. One highlighted article in that collection examines why Elon Musk would find it difficult to decouple Tesla from China, despite periodic speculation about a potential sale or spin-off of its Chinese operations. Musk has publicly denied any plan to sell Tesla's China business, but the very existence of such speculation underscores how deeply intertwined Tesla is with Chinese manufacturing, supply chains, and the domestic EV market. The SCMP coverage emphasizes that Tesla's Shanghai facility is not only its main production hub for China, but also a critical export base for Europe and other regions. This makes China's policies on EVs, data security, and foreign firms highly consequential for Tesla's global strategy. At the same time, competition in the Chinese premium EV space is intensifying rapidly. The SCMP notes that Xiaomi, one of Tesla's rising competitors, has launched a premium SUV priced at about a 23% discount to Tesla's Model Y/L, directly targeting Tesla's core segment. In addition, the SCMP highlights that BYD, which is simultaneously a leading EV maker and a major battery supplier, is preparing to unveil its first humanoid robots, stepping into the same broad physical AI domain that Tesla and Nvidia are focusing on. This suggests that Tesla's competition with Chinese firms is no longer limited to cars, but is expanding into robotics and energy storage solutions as well. For Tesla shareholders and enthusiasts, the Chinese context presents both opportunity and vulnerability. On one side, China offers enormous scale, sophisticated suppliers, and accelerating EV adoption, all of which benefit Tesla's volumes and cost structure. On the other, price wars, local innovation, and geopolitical risk could pressure margins and complicate long-term planning. Musk's rejection of the idea of selling Tesla's China operations underscores that the company still sees the Chinese ecosystem as indispensable for its global ambitions in EVs, batteries, and potentially robotics. According to the Rio Times coverage of the lithium sector, Tesla also appears indirectly in the broader story of raw material dynamics that affect its long-term cost base. The article describes a sharp rally in lithium-focused equities, including the Global X Lithium and Battery Tech ETF and major producers like Albemarle and SQM, driven by renewed confidence in electric vehicle demand and clearer lithium policies in Chile. The report notes that the International Energy Agency estimates that electric vehicles accounted for about 1 in 5 new car sales globally in 2023 and highlights that automakers such as Tesla and BYD continue to sign long-term offtake agreements with lithium producers. For Tesla investors, this reinforces 2 key points. First, structural EV demand remains strong enough that the market is again willing to bid up lithium producers, indicating faith in long-term electrification trends. Second, Tesla's long-term contracts and relationships with suppliers are likely to be crucial in navigating future supply constraints and price volatility. As Chile cements more stable frameworks for lithium extraction and Argentina and Bolivia evolve their policies, Tesla's ability to secure cost-effective, sustainable lithium could become a competitive advantage versus smaller or less vertically integrated automakers. Across these stories, a common thread emerges. In the equity markets, Tesla's stock is under near-term pressure, but major long-term holders like Ark Invest continue to buy into a vision of Tesla as a dominant AI and autonomy platform. Strategically, Tesla is pushing aggressively into robotics with Optimus and Robotaxis, even as analysts compare its approach with infrastructure-focused players like Nvidia and as Chinese rivals like BYD and Xiaomi encroach on both EVs and humanoid robotics. Operationally, Tesla's vehicle business is delivering strong numbers in markets like Australia, contributing to the cash flow that funds these ambitious projects. At the same time, labor tensions in Europe and intensifying competition in China remain key execution and geopolitical risks. For investors and enthusiasts following Tesla, the current phase is defined by heavy investment, strategic repositioning, and heightened competition. The payoff, if Tesla's autonomy and robotics bets succeed, could be enormous, but the path includes real volatility in both the stock price and the company's financial statements. Thank you for listening to Tesla Daily News. If you enjoyed this episode, please subscribe and stay tuned for our next update.